Joined first on CNBC by Deputy Treasury Secretary Wally Adeyemo. Secretary Adeyemo, thank you for joining us this morning from Washington. Appreciate it. You know, just on this deal we were talking about that came together between Treasury and 11 big banks to get deposits to First Republic. Can you tell us a little bit about how that came together behind the scenes?
So, Sarah, I want to be clear that while the Secretary did talk to Jamie Dimon about the deal, it was the banks that came together on their own to demonstrate confidence, not just in First Republic, but in the entire banking system. And them working as a consortium of the biggest banks in this country to demonstrate that not only regional banks, but community banks in this country are a safe place to put your deposits, we think was an important step in addition to the actions the government took over the weekend to provide more liquidity for those banks and to resolve two banks in a way that made sure that all depositors are made whole.
But we were just talking about it, Secretary Adeyemo, you know, measures to try to shore up confidence, and yet there are still questions. Are all depositors, uninsured depositors in the U.S. banking system protected right now?
So, Sarah, let me tell you what we've seen. We've seen that over the course of the week, deposit flows have stabilized in regional and small banks, and in some cases have modestly reversed. And this was due in no small fact to the fact that the way that we resolved the two institutions that failed, using the systemic exception to demonstrate that we were going to protect not only insured depositors, but also uninsured depositors, and providing liquidity to banks in order to meet the demands of their customers. Ultimately, the president has made clear that our goal is to protect depositors, to make sure that they have the money they need to run their businesses and to make sure that their families are taken care of.
But I guess the question becomes, what next? What if there's another bank? Look, we've seen a domino effect already. It hasn't been ring-fenced by SVB or Signature, as you guys were hoping. So is the presumption that if another bank runs into trouble, their depositors will also be made whole?
So, Sarah, what I'm saying is that in the data that we've seen over the course of the week, we've seen deposits stabilize in small and medium-sized banks. And in some cases,
First Republic just had to have a $30 billion infusion.
Reverse.
It's not stable.
So, Sarah, you're right that the big banks in this country provided $30 billion to First Republic in order to put them in a position where it was clear that they had the money to meet any demands by their depositors. But it wasn't an infusion just in First Republic. What these banks were doing was sending the show of confidence from these biggest institutions in the entire banking sector. Which was important because it was important for people to see that your money wasn't only safe if you sent it to a big institution, but it was safe if you sent it into the system. So we welcomed that move, and we think that in addition to the moves that we've already taken, have put us in a position where you've seen stability in terms of outflows from some of these banks.
You know, some people, Secretary, have talked to me about the bondholders, for example, in SVB or Signature. Concern there about regional banks, community banks' ability in the future to actually sell bonds. In other words, I mean, you got to keep your cost of funds as low as you possibly can. If you crush the bondholders or continue to, you raise costs for these banks, and some wonder about their own viability in our financial system in the future because of that. How do you view these continued, dissolutions, so to speak, to the extent that if we continue to see the bondholders taken out at, pennies on the dollar?
So as you know, our resolution process is very clear in this country in terms of the way that people are paid back as assets are sold. But I also want to be clear that the FDIC's goal is to sell those institutions. And they have actually opened up a bidding process, both for Signature Bank and for SVB, in order to sell those assets. The goal ultimately is to do what is the least cost for the American people, and we know that the least cost is to try and sell these institutions as quickly as possible, and that's what we're doing.
You know, I wonder in this entire situation whether some believe more regulation would have helped identify the problems at Silicon Valley Bank. Others say, well, what exactly was it? They weren't matching duration with their deposit space. They went long, but, they owned what were safe assets, Treasury Securities, GSEs. Do you feel that more regulation would have potentially prevented SVB from making the decisions it did, and therefore we wouldn't be in the spot we are now?
My view is that we have to do a careful review of what happened at SVB and Signature Bank to better understand what the causes were of those banks' failures, and then we need to address it working closely with Congress. The president has called for them to look at additional regulatory solutions to try and make sure this doesn't happen again. I think that's important, but it's important that we do it after a careful review of what actually happened to these institutions so that we're in a position where we can make sure that this, in the future, we have a better financial system that continues to secure the future for the American people. Ultimately, what people do is they put their deposits in banks in order to do things like be able to afford to send their kids to school or to be able to run their small businesses. And our goal is to build a regulatory regime that continues to make that safe for people.